Hey guys, Freaky Finance here. Last week we did quite a flurry of videos. The one that I did last week was Primaris REIT, at least as a deep dive. This week it's going to be another REIT. One of the reasons that I'm doing REITs right now is because, well, on the defensive side, utilities and US consumer staples have outperformed year to date quite meaningfully. And what I'm trying to do is find opportunities that have come down, say 20% on the year, buy them, but are still actually pretty stable cash flows. So basically, I'm selling some of the outperforming utilities and rolling them into REITs, and then hopefully I ride those back up to catch up to the utilities that have been fairly steady. That's the idea behind it. It's I generally like REITs, but usually I do them near the end of the cycle. It's the thing that I slowly add out of like the high growth names. Anyway, there's some preamble there. So we'll go into Dream Industrial REIT today. I don't own this one, but I'm probably going to talk myself into it. Alright, Dream Industrial REITs. Really, Industrial REIT, you're thinking of your warehouses, so the picture here, right? A lot of distribution, a lot of logistics. And basically, the tenants lock them in for quite some time. Their average WALT, so weighted average lease, 4.6 years. Generally what that means is that they have a lease with their tenants on average right now at 4.6 years. As a REIT, you have a lot of tenants, and basically as they roll off, you'll be able to either charge them more after the lease. Some leases will have rent escalators during the year, but as the rate resets or the lease resets, you have an option as the landlord to either keep the tenant and charge more, or the tenant leaves and then you find a new tenant to charge them at the market rate. We'll talk more about the rental spread here in a bit. It's one of the things that's very strong with this company. It has about $6 billion in assets, slightly more than that now. But 6 billion assets, 63% Canada, 37% Europe. Anyway, the distribution yield right now, after the sell-off, or it's come back a little bit since then, since really started looking at REITs. But anyway, it's dividend yield about 5.4%. Pretty solid right now, and it also has a NAV discount, so a discount to its NAV, which is also unique for this company. Usually that's happened very often, though a lot of the REITs right now are at a discount. That's why I'm starting to do REITs, right? I'm starting to get a deal on underlying equity. So anyway, that's kind of the outlay. Tenant wise, you can see it's 68% distribution and warehousing, and then 20% light industrial. It's kind of a catch-all. This is more informative for me. So 20% logistics, 14% consumer goods, food and beverage 13%. So it's fairly diversified industry-wise, but the tenant breakdown was special because the highest tenant exposure is only 3%, which is nice. A lot of REITs have a tenant that could be sometimes in the 20s or more, even 10's high for me for a REIT. So I like this. There's not, basically it tells me they have the power against the tenant. So I like when the landlord has the power, and when every tenant's so small, if they walk away when they try to increase the rent after their lease terms up, then they'll just find a new tenant that will pay that because that's what the market rate is. So I like that. I like Michael Porter's 5 Forces. Checks that box right here. And they are a little bit all over the place, right? They're logistics, but they're all shipping different things, right? For agriculture, for nutrient. I don't think I did a video on nutrient, but I've followed it for a long time. Anyway, there's not a lot of, obviously, key tenant risk here, which is another check mark for me. But this is the main side of the presentation. I'll go through the financials really quick, but you can see basically in place rent. So that's like the current average in the blue, what they're currently charging, and the current mark to market. So basically the current estimated market rent right now. So if all the leases were to reset tomorrow, they'd be able to charge this much per square foot instead of this much per square foot. And that's a big rental spread, and it's only increased since this presentation was put. This is like May. And the occupancy is also super tight, which again tells me they have the power to raise rents. And it also tells me that this mark to market is probably true. Is that the current tenants are getting a decent deal. Year to date, an average rental spread of 21%. So as the leases roll off, they're able to increase rent by 21% year to date. So it's not just some made up rent spread that's actually being executed on as we speak, and we're going to see that in the numbers in the last quarter we're going to go through. And that's important right now, especially as utilities are so high on these REITs. I think that's one of the reasons why the market penalized them, say, more than the utilities or the staples. Also, a higher interest rates means higher cap rate, which means they reduce the property value based on accounting. Not technically if the property values are going down or not. It's based on accounting for properties. And that also puts downward pressure on the property values that are on the books, which might explain why the NAV discounts are so high. The market's front running these what it believes will be declines in property value. But again, that's generally an opportunity, is usually when it happens, right? Could be early here with this idea, but I'm starting to like it, right? Especially with this rent spread in the back. So how is the leases rolling off, right? Is it going to happen all at once? Like, when are you going to capture the spread? And then you can see it's fairly staggered. So the black is what expires in Canada in that year, what expires in Europe in that year. And you can see, like, this year's fine, it's still going to go up, but it's only 6% of their all their leases are resetting this year, where they can get that extra, say, 20% rent spread. But again, it's 14, 11, 12, 15. So what I like about this is that it's going to be a long-term story of year-over-year NOI growth from the rent spread. So it's not just like, oh, 1 year. This could be something that is going to keep shooting and FFO up like 5 to 10% each year, just on higher rents on the same property values. Right, when I'm getting a discount to the current property value at the current equity price. So it's very exciting to me anyway. Because right now the stock is at 13 and the NAV I think was at 16. So it's a pretty good discount, right? $3 a share in discounted property value that the market's already taken into consideration. And this is the cool thing for me, is I really like this strategy. So since COVID started, they've been refinancing, and what they've been doing is borrowing money in euros at very cheap interest rates. So you can see their average interest rate went from 3.6% year in 2019, so not that long ago, to 0.85%, which is pretty special. And one of the reasons why they did this, it also makes a lot of sense to me, is the natural hedge. So they had a lot of property values that were in Europe, and basically in Canada you're reporting Canadian dollars, so you'd have this translation, right, that you'd have to mark up the value of the so either mark down or mark up the value of the European property assets. Sometimes at whatever the euro rate of change was, right? So if it went up or down, weakened, strengthened versus the Canadian dollar, you'd have this charge on the books, whether good or bad. And it would add to a lot of noise. And it also is a risk thing. So what they did is they tried to borrow what they needed in euros to offset the property value delta. So now they're translating both the assets and the liabilities at the same time to try to kind of naturally mitigate. It's a natural hedge in a way, the translation process when they report in Canadian dollars. So I like this on that count as well. But the main one here is that they're saving a lot of money in interest rate expenses, and I think this is special. So that's why I'm doing the video, obviously. Again, these are just examples. So this one, their recent acquisition in Canada. These guys are growers as well, and we'll talk about some of the acquisitions and what we're seeing. But anyway, 100% occupied. The average in-place rent is 25% below market. Again, so it's adding to that rent spread. It just tells you how hot industrials have been over the years and how much of a lag Dream Industrial REIT specifically has to that increase in rents. Kind of talked about the assets, well, not really. So this is on their latest Q2. Here, I'll blow this up a little bit so you guys can read it. But anyway, 257 assets, 372 industrial buildings. We've kind of already talked about distribution, logistics, and industrial. In Canada, we focus on the mid to large bay properties, primarily in GTA and Montreal. When it was Canada, a lot of it was in central Canada, in the more densely populated parts. In Europe, again, it's mid to large bay properties, but this time in Western European markets, so not Eastern European, which is good right now. And then they have an investment in the US. Let's see the rent spread in action, and then we'll go through the numbers because it helps explain what we're seeing, or what I'm seeing. So So here you can see Ontario and Quebec, which are the big guys for them. You can see Ontario is actually bigger than all of Western Canada for them. But the thing, like you'll see the increase. This is 6 months. You see the increase of 3.8 million, which is 15%. Part of this is also from acquisitions. This increase in NOI. But you can see change in place rents up 10% year over year. And again, this was only with a smaller portion of the rents resetting this year, and then rate of change it goes up next year. And you pretty much get 5 years of this capturing the rent spread, assuming the rent spread stays, which is another assumption. But you can see what I'm looking at here is very impressive, right? So constant currency basis, you're up 10% in NOI year over year, with 6% increase in place rent changes. So pretty special. And you can see the largest rent spreads are in Ontario and Quebec. So there is a little bit of an increase in Western Canada, but it's definitely not to the same extent to what we're seeing in Ontario and Quebec for industrial logistics. So that's pretty special. Again, this is on the annual. So I was talking about the lease spread. I was trying to understand, like, where is it coming from? Has it been there for a while? It's been there for a while, but it's gotten a lot bigger lately. A part of that is due to inflation. I also think part of it is last year when the logistics, a lot of goods were moving. They've been able to increase rents. So we'll see what happens if that's just some COVID noise that's overshooting the rent increases, and it'll come back. But as it stands right now, when I'm doing this video, it looks interesting. In Europe, they have less of lease spread, but at the same time, 90% are indexed to their CPI, which is going to be very important come winter if people are right on the energy shock that Europe is about to experience. And again, I flag the 1 billion unsecured 0.4% borrowing. It'd be nice to borrow at 0.4%, wouldn't it? Especially if you could buy these assets that are having such big rent increases. Oh, anyway, again, this is the cost of debt. What I'm trying to show here is just the WACC going down. So you can see their weighted average interest rate on the debt part going from 2.5 to 0.83 in just 6 months. So this is the annual. Sorry, this is the year over year annual number. So I wanted to show that because you're like, wow, that's quite the interesting change, right? Pretty much just saving a lot in interest year over year. And then you're also when you refinanced it, they actually were able to get that cheaper rate without having to secure their property. So a lot of the debt that they borrowed isn't actually secured to the assets. All right, on the debt maturity profile, also looks pretty good. Some of the higher interest rates, higher as at 1.35%, are rolling off soon. You can see that it's fairly well staggered. Some years are a little bit higher, but given the low, another thing I like about this company is the low debt to asset value. A part of that's also because they've been increasing the property value of their investments, so it's also it looks like it's gotten better over time, because they continue to appreciate the property value, which could be a risk, right? You're buying something that keeps marking up its property value. At the same time, the existing debt is very low relative to that property value, so it gives a cushion in my eyes, which is another thing that this company has going for it. It has a lot of check boxes that I like. There's very little that I don't like, which is a rare thing. ATM, so they did some equity raises to finance some of the acquisitions, so you're going to see dilution when we go through the numbers real quick. They did ATMs at 1670, and I did another one, I think in the 1627. So both times we were at 16 and up. Right now it's at 13, right? Because there's been the sell-off in REITs, hence the video. And so, while they're starting to come back with the general market, it's still pretty interesting. So it's some place to look at anyway. I know some people really like income producing things, and REITs are usually, in my eyes, one of the best. Actually, it is the best historically to make consistent money over time. That isn't to say they're not volatile during periods of peak stress, but they're generally nice places to be over a long period of time. Anyway, So let's do the last quarter. It's the most recent. So you can see property rent increase. Specifically, it's up 20 million year over year. Though a lot of this is acquisition, so don't get too excited. But so 1.6 million on the Ontario side, Quebec's 1.4 million. Again, that's this slow, steady increase as the in-place rents roll. So that's what you want to keep seeing each quarter. Especially next year, it should be a little bit more if the lease is expiring, and then you kind of get this extra, 12% of in-place rate leases roll each year for the next 5 years, right? So this should be a continuing theme, is what I'm trying to say. And on the OPEX side, a little bit higher. We've seen utilities actually be up quite a bit year over year so far. And property, if property value keeps going up, like they keep marking up, then obviously property taxes should follow that if they're marking up correctly. So that's also going to put pressure, and that will come on a leg as well. So you should see both these things go up, but you can see the net take is pretty high, right? They're definitely a fairly lean business. They also report their investment in the U.S. fund here. That has noise though, because that company also has to mark to market their property investments, and that comes right to this line. So there's a lot of noise. I actually treat that type of stuff down here like it's not that important to me, because I don't know what that's going to be from quarter to quarter. I just know it's likely that they've gone up for a reason, because there's a scarce demand of industrial logistics plays in Canada, or at least that's what it would appear to be given the in-place rent spreads. Anyway, what else do I really like? So here's the G&A expense is the only weakness for them. I need to dig into that and see why it increased. You might be like, well, it's only $2 million, but that's a big jump year over year, so I don't like that. So I need to dig into that. Is it crazy? No, it doesn't change anything, but it's something that I don't like, right? So there is something. Interest expenses, so this is the fun one, and this has been the trend when we do the annual. Here, I'll just click the annual real quick, blow it up a bit just so you can see the interest. This the change, right? So you're going from 34 million to 24 million, so you're saving about 33% on your debt, and that's pretty much in line with what we're seeing here. I'm pretty sure that's about 33% going from 7.5 to 5. Yep, let's call it 33. So you're saving a decent amount on interest expense because of that borrowing in euros at very, very low rates. Like when we go to the debt maturity, you can see some of these rates are 0.54, right? All right, and you can see the operational performance. So that's basically what I do, is just take the rent less the expenses required to make it, and it kind of gives me a rough idea of how much the FFO should increase. It's not always true, but it's a way that I can cross-check their FFO number. If that makes sense. The numbers will never match, but it's the increase, the rate of change should match. So like if I see, okay, you're up 18, I should see your FFO go up about 18, which I do. So I like that. That kind of tells me that, okay, there's nothing crazy going on. It's usually just a little thing that I do. Fair value investment, so that's the market to market the properties. They've been going up for some time, so that is a risk here. One of the reasons the market might be giving a discount to the property value is they think the property value is marked too high, right? The fair value financial instruments, so that's swing is driven by interest rate swaps, so cross currency between Canadian and euros. So that's a lot of noise too. So quarter to quarter. So whenever you look at a REIT, you never really look at this net income line. I don't think I ever have, because there's just so much noise. You get both of these things that just totally dominate the year over year performance on an earnings per share. So really, when you look at REITs, you got to look at that FFO and adjusted FFO. The unit price, so the video, hence the videos, because it's come down. It's recently rallied since the middle of July, but it looks pretty interesting anyway, right? I think this is my angle. I think personally the share price is more focused on dilution than the assets that were acquired. The company has issued both shares and debt for acquisitions. We already talked that the ATMs were over $16 though, so it's nice. Company's worth about $400 million more in equity EV, but the FFO accelerated meaningfully as well. as well as the net asset value has also come in quite a bit because of the things that they purchased with the equity value raises that they did. Total assets is dominated by as you'd expect, the investment properties on the books on the balance sheet. So you can see you have 6.4 billion in property value in your investments. And that's pretty much dominates the entire total assets, right? They had 81 million in cash, but everything else was very small. Even the cash is small. Not done. Debt. So this is like your spread. So when you see investments at 6.4 and your debt, your total indebtedness, so that's your mortgages and what they borrowed, say, not unsecured, you're at 2.2. So you go 6.4 minus 2.2, you're at 4.2, right? So you're 4.2 in on net assets, but your equity market cap is only 3.5. So you're basically getting 700 million in property value. That's not accounted for in either the debt or the equity, and that's either the market's telling you in the equity that they think they're going to decrease the property value by about 700 million, or it's telling you that there's probably an opportunity here. Right? My eyes, it would appear that there's an opportunity here, partially just due to the rent spread. The NOI growth should dictate that the property value should actually keep increasing over time. Assuming if you believe that property value should be linked to the income that it produces versus what you think the cap rate will be, because as interest rates go up, you should see actually them write down their property value of the investments, but technically the underlying asset might be doing better than it ever has, which is an interesting dichotomy at this time. Occupancy rate, again, that tells me that the base is strong. So are the industrial REITs able to stomach these fairly big rent increases? So far it does, or if they're leaving, they're able to replace them very quickly, or replace the tenant very quickly. The only thing there is the GA percent of revenue has gone up. So I'm not sure why you'd have negative scale on rent increases. So again, that's something I need to dig into. On the interest side, you're instead of 10% of revenue, you're down to 5.5% of revenue. So it's very exciting to me, especially in rate of change terms. FFO per share has gone up meaningfully. The average in-place rent continues to increase, which tells me that they're actually, instead of just some fictitious rent spread, they actually are getting some of that rent spread over time as the leases roll. We should continue to see this go up year over year. The estimated market in place, it was 19.6 at the end of the year of December, but now it's at 42, which is, it's just crazy. That tells me that the rents are kind of out of control right now. Maybe the market doesn't believe that they're actually going to be able to increase rents that much as they roll. So we'll have to see. This was on the Canada side, not the EU side. The EU side spread's lower, and obviously the Western Canada side's lower. A lot of the bigger spread is right now in Ontario and Quebec industrial properties. So there's something going on there. And I probably need to dig in deeper. One of the things when I'm dancing to different industries and different assets and different sub assets, you never get like what's the driver here, right? I technically don't know because I'm not in Quebec or Ontario, and I'm not a landlord who's saying that we can actually increase rents 42%. So usually the truth probably somewhere in the middle. But we'll see. Weighted average lease term continues to increase. It's not a good sign. Again, it's industrial, so you kind of get that staggered as interest rates and inflation increases. You're able to capture it on a lag as the lease rolls. Some of them will have inflation riders, like your EU ones did. But one of the things I like about REITs is that you do get this contracted cash flow on the industrial side. Office REITs obviously have longer walls, but industrial's a fun one, especially when they're at a discount finally. Especially with these big rent spreads and all this. There's a lot of things I'm like, wow, this could be a good one. But who knows? This could be misleading, right? This rent spread, but so far they are capturing it slowly as the leases roll, or at least that's what the year-over-year increase in NOI would tell me. So anyway, that's Dream Industrial. it is definitely a fun one with a lot of good stuff going on for it, and I do think that smart refinancing euros was clever. But anyway, I'd like to know your thoughts on Dream Industrial, and have a good rest of your week.